My name is Brian Huang. I am one of the co-founders of Glider. I've been in the space since 2014, which is pretty crazy.
You're calling Glider the wealth front of crypto. Traditional fintech is full of smooth UX and zero self-custody. Crypto is full of self-custody and bad UX. How do you merge those two worlds?
So what's interesting about Glider is we're not focused on things that you can do in traditional finance. The biggest thing and the most simple thing that you can do on Glider is create an ETF. And it's a very different type of ETF, to be clear. You own all of the underlying assets and you actually get direct ownership of them, which means you get the voting rights associated with them. You get the dividends. You can lend these assets. You can actually earn yield on these as well. That's what's really cool. There's nothing between you and your assets. What's cool about crypto rails and programmable finance is how the money moves between these seamlessly, because that's something you can only do in crypto.
What's your crypto aha moment?
I think it was early on with Uniswap, honestly. Like the fact that you could deposit cryptocurrencies and earn yield from LPing. That was the moment I realized, look, there doesn't need to be anything between you and whoever is borrowing against that or trading against this pool of assets. I think for everyone that we've formed on this team, it's very clear that we hire people who want to change DeFi. This has nothing to do about pumping a token or shilling a token. That will come. The best products, though, enhance what the users can get economically, and they can also get in terms of a product. And we've built the team to build that. One of the things that we like to think about at Glider is like, how can we make everybody their own manager of assets?
Hey, When Shift Happens family. Welcome to Drops, a podcast series where we showcase smaller rising star projects in the crypto space. Since When Shift Happens started to take off, we've received hundreds of requests from many great projects every month that we had to say no to because they weren't a good fit yet in terms of size and impact. But this has now changed with the Drops podcast series. We're building When Shift Happens, the most credible platform in crypto. And there is no reason why smaller projects with big potential shouldn't have a chance to be heard. Drops is not a research service nor an endorsement, but a way to give a voice to the potential big crypto founders of tomorrow. Who are you?
Who am I? Great question. Wow, that's a good one. Caught me off guard a little bit. Who am I? So my name is Brian Huang. I am one of the co-founders of Glider. I've been in the space since 2014, which is pretty crazy. Had my first Bitcoin in 2014. Wish I had kept it, obviously, but you know, you live and you learn.
What did you do with that Bitcoin?
So I held that Bitcoin. I got a third of a Bitcoin from MIT in 2014. They ran a fairly famous experiment. They gave everybody a third of a Bitcoin.
You studied there?
I did.
MIT.
I did. I graduated from MIT with a double major in computer science and management. I also minored in architecture, among many other things, but I was a little bit all over the place.
Maybe that's why you like the place, because of the book there. Like you see like the cool architecture and design of that place. You're like, man, that's the kind of crypto shit I want to see.
I mean, everything we do in Glider, to be very clear, is quite tasteful. Like design, especially in this world where AI is rampant and you can create videos that are very clearly AI generated. Everything we've done at Glider has a designer doing it with their hands. Like we contract with a number of designers out in Paris. Our designer is based in Paris. That is actually how you build moat at this point of stage, right? You build design, you build brand around that, you build trust with that design. And I think that's what a lot of DeFi applications are lacking these days. They just don't have good user experiences and they don't abstract away the complexities of DeFi to the end user. That's it. It all goes back to user experience. If we can make user experience better, we will get more people to use our application and other people's applications as well that we can embed into, and that will grow the crypto pie for everyone.
So you got this 1/3 of a Bitcoin at MIT?
Yes, I changed the topic on you, yes. Third of a Bitcoin, I sold it in 2017, tripling my investment, thinking I had absolutely crushed it. Other people sold it immediately. This was also a very different era of crypto. So to give you a sense, Circle was doing custody. I had a Circle wallet. I don't know if any of you remember that one, but I had a Circle wallet, didn't know what I was doing with it. Eventually had a Coinbase, account, and I was trading on GDAX, which, if those of you remember, was a predecessor of Coinbase Pro. It was free to trade. Like, what a wild time. Free to trade. Maker and taker fees didn't exist. Anybody could trade. So what? Fast forward, left MIT, worked at a big bank, Morgan Stanley, traded bonds there, saw literally firsthand how extractive big banks can be. Not only just charging bid-ask spread, but like, bullying clients in a very sort of acceptable way, let's put it that way.
How do you feel about that?
Well, I think having worked at a big bank, I understand how traditional finance works in a very nice way. So I think it was a learning experience. Was it something that I think if anything, I learned what not to do. Let's put it that way. And I think those are actually really valuable learning experiences because you understand, okay, how does a big company work? Morgan Stanley is like a 50,000 person company. Like, what does it take to operate at that scale? And then also, like, how does the business earn revenue? And how can you disrupt that? And that's what crypto is coming in to do. They may not know it yet, but it's coming. It's coming.
It's coming, and it's coming at a certain pace, for sure.
Yes.
For sure. Tell me something about yourself or your life that can help me and the audience trust more what you'll share with us today.
Yeah. The main thing that we think about here at Glider is how do we build trust with our users, right? Everything that we do in this product is non-custodial, which is important. We don't have anything to do with your seed phrase or private keys. When it comes to me, I talk to engineers, I talk to builders all the time who have been debanked because they live in Ukraine or they live in Argentina. And there are real use cases for crypto there, right? Like that is interesting to me.
There's a pattern across my guests.
Yes.
Something early that gave them a chip on the shoulder, that gave them a fire in the belly. What happens in your life that make you hungry for success and this ambitious?
I think there's an inevitable drive to win here, right? I think for everyone that we've formed on this team, it's very clear that we hire people who want to change DeFi. This is nothing to do about pumping a token or shilling a token. That will come. The best products, though, enhance what the users can get economically, and they can also get in terms of a product. And we've built the team to build that. And so I think having an understanding of this team is very, very focused on just building a product. We are not here to shill a token. A token could potentially come, but that's later down the line. And I think a lot of teams get that wrong.
Absolutely. I mean, they get that wrong on purpose, probably, most of them. You mentioned before I work for these big banks and I saw like how extractive the kind of process is, but they do it in a kind of acceptable way. What's your crypto aha moment? Because you said you received this 1/3 of a Bitcoin, but you probably didn't really realize what it was. What's the moment you're like, holy shit, like this is it. Like I need to do this.
Yeah, I think it was early on with Uniswap, honestly. Like the fact that you could deposit cryptocurrencies and earn yield from LPing. That was the moment I realized, look, there doesn't need to be anything between you and whoever is borrowing against that or trading against this pool of assets. Like AMMs themselves are probably one of the biggest inventions of crypto. It's probably AMMs and perpetuals. Look, like a way of gathering capital in a decentralized, permissionless way where everyone can actively participate and earn from it is really cool, right? You don't need now a middleman or a bank to actually aggregate this money for people to trade against. And so that's probably like what, 2019, 2020 era, DeFi summer, getting into there. That was the aha moment, really.
How long did you take from that aha moment to say, I need to go all in?
Yeah. I mean, I was a big part of DeFi summer, a big part of NFTs and that whole pump. After that, I was at a trading firm at that point that traded crypto. And so
For the firm.
Exactly. So we were trading crypto, very small amount compared to what we normally trade. It's vastly FX, equities, and futures.
And you were doing that full time on crypto? Or it was kind of part of your job?
Part of the job. So geographic coverage, obviously crypto is 24/7, 3 teams, US, Singapore, London. I would cover New York time zone. And so all of crypto that traded during that time went through me. Yeah.
You're calling Glider the wealth front of crypto?
Yep.
Traditional fintech is full of smooth UX and zero self-custody. Crypto is full of self-custody and bad UX. How do you merge those two worlds?
So what's interesting about Glider is we're not focused on things that you can do in traditional finance, right? This is trading and this is lending. You can do that in traditional finance, right? You see a lot of these trading apps out there and even perpetual exchanges where CME is going to come in and launch perpetuals eventually once it's legal in the US, right? Also, Robinhood, Coinbase, they already offer very similar trading experiences with massive distribution. That is not interesting to us. That is stuff that you can do without crypto rails. What's cool about crypto rails and programmable finance is how the money moves between these seamlessly, because that's something you can only do in crypto, right? If you think about your money in Coinbase and your stocks in Robinhood today, to move money between those places, you need to go through a central bank, which is like a Bank of America or a Chase. That process will take 4 days to go from one to the other to the other. It's not like that in crypto because everything is permissionless. But nobody has solved for the fact of actually being able to orchestrate these assets in a way that can only be done on DeFi. And that's what's interesting. Like, what can you actually unlock with DeFi that you can't do in traditional finance? And it's not swapping. Let's be very clear. You can swap in a million different places. That's not interesting, right? That's very commoditized. It's actually, how do these assets move? How do you make that process seamless? How do you have users not care about chains, not care about native gas tokens, and then reap maximum capital efficiencies, right? Money that moves, increasing that velocity is critical to the growth of crypto. That is why people use crypto, right? People can move money instantly and seamlessly and know that it's programmatic. That's actually what's cool here.
Give me some examples of these huge unlocks of going all in DeFi and just kind of skipping completely the traditional financial system.
Yeah, I mean, the biggest thing and the most simple thing that you can do on Glider is create an ETF. And it's a very different type of ETF, to be clear. You own all of the underlying assets. So let's say, we'll give you a very simple example. There was an ETF for the Magnificent Seven, right? Stocks. That's great. But in traditional finance, BlackRock is charging you maybe 10 basis points a year to hold that ETF. In crypto, you don't need an issuer. So with Glider, you can take those stocks, on-chain stocks, hold all 7 of them, and you actually get direct ownership of them, which means you get the voting rights associated with them. You get the dividends. You can lend these assets. You can actually earn yield on these as well. That's what's really cool. There's nothing between you and your assets. We don't need the middlemen. In fact, we can copy any ETF that is ever issued by anybody on a tokenized asset, and we can undercut them immediately. There is no barrier here. We could drive fees to 0 if we wanted to. That's what's cool.
Maybe can you explain the business model of this, for example, an ETF provider or a stockbroker, right? Security lending, they're lending your actually Tesla stock to make a yield that they keep for themselves, and so on and so forth. Like, can you explain, take some example of like, hey, traditional finance, because you worked in this industry for a long time, a broker, this is what they do with your stock or with your ETF. That's how they make money. And now, thanks to us at Glider and thanks to crypto power, this is all going to you on the top of the stock appreciation or basket of stock appreciation.
Exactly. We can do a very simple example. Okay, Tesla stock. Let's say it's on-chain. Okay. For you as a user, you don't even have to know it's on-chain. It's just Tesla stock. All right. In traditional finance, your broker is holding that Tesla stock and they are lending it to short sellers. Those short sellers can borrow the stock and that broker gets paid a percentage yield on that. Something like, it depends on how hard it is to borrow that stock, but it could be 1% annualized, it could be 10% annualized, just depends. That's great for the broker. They can make money off of that, but it's your stock. So like, shouldn't you get that yield? And that's what's possible in DeFi. You know what I mean? Like that, there's now no middleman broker here who has to say, no, I'm keeping that for myself. You can actually invest Tesla stock on chain, lend it via Morpho or any of these other lending pools, and you can earn the same percentage yield, if not more, than that broker is. And that is a huge unlock.
Absolutely. No signing, no gas, no bridging. Sounds like magic to most people in crypto. What's actually going on under the hood? Why is it such a breakthrough when it should be such a normal thing?
Yeah. I think in crypto, we have a lot of people who are focused on incredibly niche and sophisticated products and or white papers and big ideas. We have a real lack of people who can build product. My co-founder, John, built Matcha at 0x back in the day. If you don't know, that is a very early DEX aggregator. He is the best product engineer I've ever worked with. He's worked with the likes of Paradigm. He's worked with the likes of Standard, doing projects they have hired him to work on. He is the best product engineer out there. Behind the hood scenes, though, what are we doing? We've abstracted away all of these chains. You're able to trade on any EVM chain. SVM is coming very soon, and other VMs as well in the future. We seamlessly manage all of your positions, spit out P&Ls, any other information you need to know, and then allow you to use your assets as you normally would, whether it is lending, whether it is staking, governance, because they're your assets. Everything is non-custodial. Behind the scenes, when it comes to trading and swapping and rebalancing, we use DEX aggregators and intent-based solvers to simplify that for people at home. That is basically a way to move assets between chains. Because we have the users and because we have the order flow, and this is our belief for all apps, we actually have a lot of leverage over these commoditized providers. There's a million different solvers out there right now that want order flow. And if every app actually got together and said, look, we're going to use the best ones, the value should actually accrue to the apps. And then because it'll accrue to the apps, it'll actually get passed through back to the users. That's what's cool. So yeah, that's a peek behind the scenes. But it's our belief that you shouldn't really have to care, right? It should be a very seamless experience.
You're just abstracting complexity. You're abstracting the chain itself. What becomes possible once people stop completely caring about what chain they're on?
People shouldn't care what chain they're on. That's a matter of fact. People shouldn't care what chain they're on. We're in this era right now of very tribalism in crypto, where everybody cares about the chain. The only thing that will matter for a chain is what assets are on it. And if you can get stocks or you can get RWAs on your chain, that means you will be able to have users who want those assets to invest in. We think consistently about investing in on-chain assets at Glider. It's nothing to do with crypto trading. Crypto trading is great, right? The rest of the world wants investable assets. And so, yeah, we don't think anybody should care what chain they're on. Chains are commoditized. Block space is commoditized. It doesn't matter.
We talked the other day about some time you spent in San Francisco. And you said that San Francisco is kind of stuck in an AI loop and very crypto skeptical. Probably for some reasons, right? Why do you think crypto feels cold in the Silicon Valley right now?
So I'm a big New Yorker myself, and so I'm a little bit biased. San Francisco felt cold even without the AI. I think the fact that you can take a Waymo and not have a driver, go to your office where maybe two people show up, get your lunch delivered, and then take a Waymo back and never interact with the person. It's just a weird sort of dystopian experience, which is very different from the world of New York, getting into a bustling subway with tons of other people who are of all different types of, walks of life. So yeah, I didn't have the best opinion of San Francisco. Yeah, they're focused on AI. It's fine. They're focused on AI. There are incredible amounts of AI and crypto crossovers that are going to have to come, right? When we think about agents and when we think about autonomous robots and all these other things that just will roam the earth, value transfer, how is that going to occur? It's going to be through crypto, right? That value transfer will indefinitely be based off of on-chain assets moving around. And so A16Z talks about this a lot, right? There is a very nice convergence here between AI and crypto that is coming on so many fronts, right? We could talk about decentralized compute. We could talk about decentralized data gathering, and just, the pure on-chain financial rails will be crypto for AI.
A16Z. You joined the A16Z CSX Accelerator alongside AI robotics ticketing companies. You were one of the only DeFi consumer products in the cohort. 16 projects cohort?
16 companies, yep.
What was the most surprising thing you learned from the A16Z CSX Accelerator Experience?
I think what you realize when you work with A16Z is that, and I'm not just preaching this because we're a portfolio company, but they have experts in everything. Every week we spent on a new topic: policy, regulation, tokenomics, go-to-market, marketing. All of these topics, they bring in their experts from their team. And these are people that are top class in everything that they do, right? Everything that A16Z does also in these little meetings with you personally is how can we add value? And I can't say that about every VC ever, right? That's just not true. Some are just a check. What's maybe more surprising, I think, with this group is that, I have friends who've done YC. I have friends who've done other accelerators in crypto. What's cool about this is that we're all in person. It is 10 weeks of really intense getting to know each other, going through the same problems. We're all the same scale and size. And there's things that we can learn from each other, right? It's very focused. When you do YC, for example, you've got biotech and AI and crypto. It's a far less meaningful relationship building experience. I learned so much from these teams. I met with one of them in Korea last week. We still see each other all the time and chat. We're always asking for advice amongst each other because these 16 companies aren't competitive. They've done a very good job of making sure that everybody is not necessarily collaborative per se, but everyone is here to help each other.
They're not competitive, but are they complementary?
Yes.
Something I heard from a friend of mine who went to Y Combinator was that, right? Was, hey, there is, I don't remember how many per batch now. There's 4 batch per year. It used to be 3, now it's 4. Yeah. Is it 50 startups or 200? I don't remember, but the amount of money is insane, given to these startups 4 times a year. And the first thing he told me was, actually, we kind of, not all of us, but a lot of us become kind of clients of each other. So we bootstrap, there is already money, we bootstrap this ecosystem where we basically work with each other in one way or another. And so it's our first clients are part of this batch. Is it the same with A16Z? You probably much 16, so it's fewer, right? But how does it actually work? You told me also you all guys received quite a lot of money up front. Tell me more about the whole how complementary and how much does it make a difference to go through an accelerator like that? Because you mentioned these topics, right, that they bring. Probably a lot of them are topics you would never even think about if you just do your thing on your own.
Mm-hmm. Yeah. We've been fortunate to have a really nice team tackle all different aspects of Glider's growth, whether it's engineering, BD, marketing. We now have leads for all of these. The team is 8 people. When we think about complementary teams within the cohorts, one team comes to mind. It's called Sprinter. Sprinter is a solver network where they provide liquidity across multiple different chains, and we could use them as a way to swap and provide the basic functionality to move assets between all these chains below the scenes. But of course, the cohort is sort of all over the place too. There are companies that are doing decentralized media and data gathering and robotics. And so I don't think the complementary mix of those is very obvious, but maybe over time it will become that way. One of the things that we like to think about at Glider is how can we make everybody their own manager of assets, right? Because what we're building here is not just a direct-to-consumer platform. It is a way for anybody to take what we've built and embed it into their application or embed it for their users to use. And so everybody now can manage their assets, which inevitably will be across all of these financial apps, whether or not they want it to be. Because even these apps that have some form of money payment, they're still going to want to offer things like yield, right? In terms of the the round structure too, YC does 500K checks. A16Z in this case was leading many of these rounds, and so we raised 4 million, of which they put up a fair amount of that. And so I think they're far more invested than sort of the spray and pray approach.
What's one thing that when you went there in this A16Z accelerator, you realize, holy shit, like we're doing this so wrong?
I think one of the things that struck us was like how much goes into tokenomics. The idea of like buyback and burn is great. That's like very simple. But then how do you take that further? And I'll save this for a later conversation because there's a million little like secrets to how tokenomics should work. But there's a lot that goes into it. It's not just like I'm going on Pump.Fund, launching a token today. There is a lot of effort that has to go into the actual mechanisms that make your token last and have value over a long period of time. You can sort of think about it like you're a central bank and this is your currency. And you can imagine how much central banks have to do to continuously monitor the health of their economy. That's the level of like introspection that you need on a token and a token launch. So
some people say a token is a new product. Some people say a token is a new business. So managing one business is already fucking hard. Like, so having to manage two different businesses at the same time is
tokens are not the product.
Crazy.
To be very clear, tokens are not the product. And the reason why for that is that you need to make revenue. And the only way that you'll have sustainable tokens in the long term is if you can generate revenue, return that revenue back to token holders, either through yield or buybacks, and that creates strength and actual returns on the token. That is the only way to do it. Blockchains that have massive amounts of TVL will not be able to succeed in the long term unless they can generate revenue from that TVL, because TVL will always chase yield. Not relevant.
Absolutely.
You need to be able to generate revenue. And so Pump.Fund gets this, Hyperliquid gets this, Uniswap gets this. You need to be able to generate revenue for the long-term success of a token. The token is not the product.
You're going in phases to market, starting with crypto native users, then TradFi influencers, then mainstream. What's the hardest challenge to move from early adopters to normies?
There's two things that we always think about. It is where are we in our product life cycle, right? Are we ready to make that movement over to targeting normies? And then there's another scale we think about as well. How far is society along that trend, right? Those are the two sort of wheels that move here. And you don't want to be too far ahead of society because then society isn't ready for your product, right? But you also don't want to be behind society because then there's untapped users that you could be tapping into. And that's something that we consistently think about at Glider. We need to build where users are today, which is very crypto native at this point, but know that society will move forward and we need to be slightly ahead of that. That is the key. That is always the key. Crypto natives are great. We have value props for them, right? No gas, no signing, no bridging. If I told that to so-and-so on the street, they'd be like, what are you talking about? What is that? What is that? What is gas? And so the value prop will also change over time for the product as well. And that's important. We will need to say things like you can invest in ETFs and you can earn percentage yield on that, right? That is a very simple differentiator that people understand. So it'll take time, but we're building for the long term anyways. We're not here to build a product that is part of these weekly hype cycles that lasts, a couple of days. You see a lot of apps go through this. We're building here for an investable future where everything is on chain, all assets.
How far is society or civilization in terms of crypto usage in your framework?
Well, the biggest blocker right now is on-ramps, undoubtedly. This is something that we talked about with all of our CSX companies as well. It's how can we get money into the system? It is fundamentally a better system of moving money, fundamentally. But if people can't move their fiat into something that is on-chain,
absolutely,
they won't be able to invest in these assets. That's the biggest blocker. I would love for Coinbase or Stripe or Circle or any of these giant companies to come in and solve it in a really nice way. Of course, they have to battle the old guard, right? The MasterCards, the Visas, the Bank of Americas, all of these people who are trying to play catch up at this point. So that's the biggest blocker and where we are in society to getting people on chain. The other part is user experience. And so that's the whole focus of Glider. Make sure everything is abstracted away as possible and keep things simple. We don't even say things like USDC if we don't have to, right? It's USD.
Yeah.
Coinbase Bitcoin, wrapped Bitcoin,
Yeah.
Bitcoin. Because all these little details matter, to be very clear.
No, you talk to normal people like USDT, USDC, on Tron. Oh shit, on Ethereum. Oh, but I need. Oh no, but sorry, you need ETH to be able to send this USDT on Ethereum transaction. But now you do it on Tron. You need Tron to pay for gas fees, and you're like, my God.
Well, I mean,
Like,
not only
this
that,
is
like
crazy.
Not only that, you first had to get a Chrome extension wallet, right? And like that already is far too much for 90% of the world to even understand what I'm doing. So like that's 3 steps ahead of that. And then after that, you still have to get into the application that you're trying to use. So it's far too complicated today.
Which leads me back to my question. How far do you think we are in this kind of grand scheme adoption? You mentioned 97%, which would mean 3%, right? Most people, we hear all type of numbers like, oh, there's hundreds of millions of wallets and... Come on.
No.
Come on.
No. There's only 1 million people on the wait list for the base app. If anybody has a wait list bigger than that, they're absolutely lying. Coinbase has the best distribution, at least within the US. And it's really easy to spin up a wallet. So it's very easy to fake the numbers. It's very easy to garner TVL when you can create a token out of thin air and boost your lending pools. It's also very easy to create wash volume in this space. So you got a lot of metrics that are flying around. The only thing that's important is revenue. Revenue is the only thing that's important, ultimately. TVL doesn't matter anymore unless you're extracting revenue from that TVL. Like if you're a lending protocol and you have TVL, sure.
Yeah.
So where are we? We're very early. We're very early. And I think we're seeing it come from an institutional side, and that's going to push the retail side, quite honestly. The institutions are going to bring on on-chain stocks, RWAs, and that's something that we're leaning heavily into. How can you invest in actual assets that provide real yields and also real access to real companies and not just non-revenue performing random tokens?
Lily from Solana, the president of Solana on this podcast, she's the one like just saying, no, this TVL thing, forget it. It's all about revenue.
Yep.
But there's still so many useless metrics thrown around for these, mostly for these protocols for whom the token is a product, right? But we'll get there. We'll get there through more of these conversations.
It's about the long term.
The revenue is hard, huh? Is hard. Hiring a bunch of Fiverr developers or users just to prop up your numbers is less hard than making actual revenue.
Building a good product is very hard.
Yeah, it's a business at the end of the day. Like we had to, or we still have to get to a place where this industry realizes that a business, whatever your crypto application is a business, and a business to be able to survive needs to be sustainable. And to be sustainable, it needs to make money.
Mm-hmm.
That's it.
It's pretty obvious, right?
It's pretty obvious.
It's pretty obvious. I think you're going to see a really nice play here over the next year where revenue generating businesses actually have long-term value in their tokens. Hype and pump are the obvious ones. And the rest, fundamentals will kick in. I don't know if they'll kick in fast enough for investors and the insider team to be able to dump their tokens on retail. And that's part of the game, unfortunately. There's a lot of people who are trying to basically get their token to have enough incentives for, let's call it 2 years. And then the team can dump the token after a year, after their vest. The investors can get out at massive multiples, and it doesn't matter. They don't care about the long term. So again, think about the long term, and revenue is the only thing that matters in the long term.
Refreshing to hear. We said before, you let users create token baskets that auto rebalance like ETFs with no fees.
Mm-hmm.
How do you explain that to someone who is outside of crypto Twitter or finance Twitter? What's one real world analogy you can give us? An example for everyone to understand.
Yeah. The stock example is the easiest example, right? Let's say you want to hold the S&P 500 and you want to hold all 500 stocks. This is what really wealthy people do already, to be very clear. What they'll do, instead of going and buying SPY, the ETF, They'll go and they'll buy the underlying stocks in the exact percentages of the S&P 500. And the reason why they do that is because they can tax optimize. You can sell the losers and you can keep the winners. That's great. Why shouldn't everybody have access to that, right? And you can do that on chain because you have decimalization of stocks. On top of that, though, you can also earn yield. And so the simplest thing, right? Like hold the S&P 500, sell the losers, keep the winners, and earn yield on top of your stock positions as well.
And this can be done all automatically.
All automatically.
You don't have to do anything.
You don't have to do anything. You can click one button, you buy it just like you would an ETF. Click one button to sell it, just like you would sell an ETF. It's all of the convenience and accessibility of an ETF with added benefits that you would never get in traditional finance.
You're pushing the idea that users can own, for example, a Tesla stock and earn yield on it through Glider. What does owning Tesla on-chain actually mean?
Yeah, there's a bunch of different approaches to this right now, right? Do you actually own the underlying security or do you own some form of wrapper around the security? A lot of different approaches. We are not asset issuers. We don't get into the regulatory side of things. So everyone's taking their own approach. It depends on how direct, if you're a lawyer, how perfect, right, that ownership is. In our world, we would like to think of it as, in the ideal world, it should be just like owning Tesla in a broker, right? You should get the voting rights. You should get the dividends. You should be able to lend it, although you wouldn't be able to lend it in traditional finance, but on chain. That's what it should feel like. And it shouldn't feel any different to you as an end user. You should be able to come into Glider or any product that offers on-chain stocks, and it's just Tesla. That's it. It's just a better way of holding it and a better way of owning your asset.
For this yield part, right? It's basically security lending or crypto lending if you own crypto. Who does that due diligence to know who to lend these securities or tokenized securities or crypto assets too? Because we've seen a few years ago that it was supposed to be, I remember, actually I had Alex Mashinsky from Celsius on this podcast. And he was just kind of pounding the table saying, he was saying, maybe it was a lie because he lied a lot. He was saying, security lending is the safest business on Wall Street. There's not a security, not crypto. There's not a single security lending company that went broke over the last 130 years or whatever, because it's over collateralized and therefore blah, blah, blah. Well, we all know what happened. These crypto lending companies were not over collateralized, although they were supposed to be. Here we're talking about lending a stock, right? Or a tokenized stock. I have no idea if there is potential collateralization, etc. Again, the goal is that most people don't care. Just like, I get my Tesla stock, I may get my yield. But behind the scene, there is some things happening where you need to minimize the risk of all this shit happening again, right? How does that work?
Yeah. Well, you don't do it halfway. That's sort of what Celsius did, right? They were in this intermediary between like traditional finance and DeFi, and were running a lending book very much like a bank and didn't have the expertise to do it, right? In DeFi, when you're lending, everything is over collateralized, which is great. You can borrow against it. But when you need to top up your collateral, or if you go get liquidated in the worst case, someone will come in and liquidate you. And the reason why they will liquidate you is because there is a profit to be made on being able to liquidate somebody who is under collateralized or not collateralized enough. That is market dynamics at play naturally in a decentralized system. That doesn't happen in a Celsius when there is nobody to come in and liquidate you because it's some guy who sits in a office in New York City who you have to call. But that doesn't
and
work.
They don't answer. They don't answer to the call.
And they don't answer the phone.
They don't answer to the fucking emails. That happens so much, right?
Yes. And then Celsius might be nice and be like, oh, hey, like you're getting close to your collateral ratio. Do you want to top it up? And then, they give you a 24-hour grace period.
They were actually doing that. They were like priding themselves like, hey, we're not like the other ones. We're not sharks. like liquidating you. We call you, we give you some
No,
time.
you need to be very strict. And that's what's nice about smart contracts and being on chain. It's black and white. It's either you are over collateralized and good, or you're under collateralized and someone's going to liquidate you. There's no relationship to it. It is purely yes or no. So that's one layer to it. There are really cool new ways to create what you could think of as insurance around this as well. This is things like working with EigenLayer or Symbiotic. I won't go into that now, but there is another layer of actually creating insurance and safety if even the liquidators don't come in and liquidate properly. So yeah, there's a lot of niceties and protections that exist in DeFi that are slow and inefficient in traditional finance.
Beyond yield and exposure, Glider lets users lend, stake, govern, all without middlemen.
Mm-hmm.
That's what you said. Almost the first sentence, right? Why does that matter more in 2025 than ever before?
I mean, look, we say it over and over again. It's your assets. Why are there middlemen between you and your assets? Even when you go into a vault, right? A vault in DeFi is still a middleman. It's likely extracting a performance fee from you. You don't need that, right? Especially if it's passive vault, right? That doesn't make any sense. Why do we need it in 2025? Because it's time, right? Like it's time to actually drive fees to zero and actually be able to hold your assets in a non-custodial way. And you as the user should get value from the trades that you're doing and the assets that you hold without people extracting from you all along the way.
How do you know? Let's say I'm a Glider user. How do you, Glider, not extract from me? If you say it should be zero, like how do you guys make money? You mentioned before it's all about revenue.
Yeah. We don't charge a fee right now. We can charge a fee. That fee, though, should be commensurate with what you think your user experience is. If you enjoy the product, there's a fee associated with that. That's just like traditional tech, right? Like you use things that you like and you're comfortable paying small fees for that. On the other side of things, we don't have to charge fees. Let me be very clear. And this is where things are going. I don't have to charge fees because market makers are making boatloads of money off of all of the rebalancing and trades that Glider users do. And so if you're Wintermute and you're making 50 basis points, which is what Robinhood pays Wintermute right now, or sorry, Wintermute pays Robinhood right now, that means that Wintermute can probably make like 100 basis points off of all that order flow. What that means is there's still 50 basis points in there that Wintermute can give up and pass back to the user. And I'm just using Wintermute as an example. It could be any market maker. So we're moving to a world now where not only is it free for the user, and this I haven't really mentioned a lot publicly, we can actually pay you to trade. That's the value because these market makers can make so much money. They certainly can give up a little bit of margin that can go through us and go back to the user. And that's where things are moving.
Give me an example of a very simple example. What does that mean? Glider paying me to trade.
Correct. So you place a trade. It's an automatic rebalance when it comes to Glider. You place a trade for $1 million, quite large, sure. If that trade gets routed directly to a market maker, that market maker will pay us, just like Robinhood gets paid, 50 basis points. That's cool. We as a company, especially at 50 basis points, do not need to keep all of that. We can give you back 10 basis points of that or more.
Why? Because you're a much smaller team than Robinhood, thanks to crypto? Is that
No.
If you explain to someone, why would you do that? Or why can you do that?
Because Robinhood isn't on-chain. That's exactly why. So that is the power of being on-chain, is the fact that all of this revenue can come directly to us or directly to the user. Depends on where you want to split the parts, how much goes to the user, how much goes to the protocol. And that's something that can only happen on-chain. So that's coming.
So Robinhood is not on-chain, therefore what? They have higher costs, they need more people, there's more compliance. Like for someone who doesn't really understand crypto, to understand, hey, this is why on-chain is so much better.
Yeah. I mean, Robinhood has a massive boatload of team, of course, but there's probably regulatory constraints around how they can pass revenue back to the users.
Yeah.
And the question is, how would they do that even? Like,
Yeah.
Like,
Yeah.
well, I don't even know what it would be.
Yeah, absolutely. You don't,
Maybe
you don't
like
have
every month you get a random deposit of dollars into like your Robinhood cash account. It's just like, it doesn't make a lot of sense. Yeah. And so there is lunch to be eaten there for sure.
Amazing. Thank you so much, Brian, for doing that.
Yeah, this has been great.
That was great. And that was, I think, very insightful and also pretty good at simplifying the whole thing. Understand why Onchain makes so much more sense and very complete. I hope you had as much fun as me.
That's super fun.